Okay, good day students. Today we're going to do a calculation on the financial statements. But before we start, there's just certain things I want you to have a look at. These are the things we're going to look at before we start with our financial statements. Sorry. Now, the first thing you need to know that financial statements is always done over a 12-month period. Right? So it's always ranging from over a 12-month period, and this is called a financial year end. Okay, so for example, now what we will normally give you in a question, we will give you the end of the year. So this is basically how it looks, right? This will be 12 months. So what we will normally give you, we will give you the end of the year. Then you must be able to go and work out what is the beginning of the year. Like for example, the question we're going to do, Causa Limited, the end of the year is the 31st of December 2017. Now 12 months before that is the 1st of January 2017, because it all falls in the same year. But what I need to tell you is that it won't always be the 31st of December. We can give you any other year end, and you must be able to calculate or determine what is the beginning of the year. Now, how do you do that? Now, you have the day, you have the months, and you have the year. Now, for you to calculate, now we always give you the end of the year. For you to calculate what is the first day of the year, you are going to take, day will always be the first, right? Month will always be the next month. Right? Next month. And the year will always be the previous year. So the day is always the first, the month is always the next month, and the year is always the previous year. Okay, let's test this. Let's test this. Let's say year end. The year end is the 31st of July 2020. What will be the first day of this year, right? So the first is always the first, the day is always the first. What is the next month of July? August. And what's the previous year? 2019. So your year will start the 1st of August and it will end the 31st of July. Let's try another one. 28th of February, let's say 2019. Okay. What will be the first of this financial year? It will be the 1st of first, which is the first. What's the next month? The month after February is March. What's the previous year? 2018. Now that's basically how you calculate the financial year. The reason why this is important is you need to find out what is the beginning of the year, because they won't always say this is the beginning of the year. They might give you a date. When you see the date, you can then know that this is the financial beginning of the financial year, which we call an opening balance, and we will give you the end of the financial year, which is always called a closing balance. Now, the reason why that is important is because of something that's called an adjustment. Now, an adjustment is basically something that is in the financial year that should not be there, or something that should be in the financial year but that's not there. Okay, let me show you. For example, let's say this is your financial year, right? Our financial year, let's say we're starting on the 1st of March 2018 till the 28th of February 2019. This is our financial year. Now, an adjustment is if something that you had to pay within the year, but it's not paid yet, meaning it should be here, but it's not here, or it is not supposed to be here, but it's here. For example, if you've paid something for 13 months, remember, a financial year only has 12 months. So if anything, let's say you've paid rent for 13 months, 1 month does not belong here. It belongs in the next financial year. Then you need to adjust it. So for example, if you always know every financial year has 12 months, right? We've agreed upon that. But if you've paid something for 13 months, it means that you paid 1 month extra. This is called a prepayment or a payment in advance. And this is an adjustment. So it means that this 1 month that you paid extra, you must take it out of this financial year. Let's say you need to pay for 12 months, but you only paid for 11 months. Basically, this means that there's 1 month outstanding. So the 1 month is in arrears, but you need to account for it. Why? Because it belongs in this financial year, and then that means you need to adjust it. Okay, so now let's do I'm going to do 2 adjustments, but before I do an adjustment, you need to remember with an adjustment, right? The statement of comprehensive income is all our income and all our expenses. So let's say, for example, our income that we're supposed to receive is for the 12 months, right? So this will go into our statement of comprehensive income because this is what we were supposed to receive. But everything that we received extra or that we received too little must go into the statement of financial position, because this now loses its form as income and expense. It now becomes either an asset or liability, because remember what I said previously, an income is good, an expense is bad. But we cannot take this, an expense and income, into our next financial year. But we can take a statement of financial position element into our financial year, which is an asset or a liability. So the bad expense will now become a liability. The good income will now become an asset, and that's why it's in the statement of financial position. Okay, so let me show you something. I want you to memorize this thing. Right, but before you memorize it, I want to give you a scenario. Okay, let's say our financial year is on the 1st of January 2020 up till the 31st of December 2020. Okay, now you have paid insurance of 1,000 rand for January 2021, and you paid it on the 30th of December 2020. So what did you actually do? This is your financial year. Your year ends the 31st of December 2020, right? Your new year starts here. Okay, let's make it another color. Your new year starts here, meaning your new year will be from the 1st of January 2021 up till the 31st of December 2021. Now, what are they saying? They're saying that on the 30th year, you paid 1,000 Rand, but it's only for year. Right. So meaning the insurance that you paid is not meant for this financial year. So as soon as it's in the year and it should not be here, we need to adjust it. Right. Now, how do we adjust it? We need to ask ourselves two questions. The first question, what is the element that we are paying, right? Which is insurance. What is insurance? Insurance is an expense, right? And how are we paying it? Is this thing in arrears or is this thing paid in advance? So you paid it here, but only for the next year. So this payment is in advance, right? Because the January 2021 it's still coming. So this is in advance or prepaid. Okay, so we know our expense goes to our statement of comprehensive income, and our advance must go to our statement of financial position. But now remember, with the statement of financial position, there is 3 elements, right? You get your assets, and you get your liabilities, and you get your equity, but with adjustments, it never affects equity. Sorry. So I must now determine which one will it be, under which section will it go. Will it go under assets or will it go under liabilities? And this is how you do that. Right. You have this block. I want you guys to go and memorize this block, but I'm going to explain it to you now. Right? We have assets here. We have liabilities. We have income here, and we have expense. Okay, now let's take this example. This is an expense, right? So we know that this is an expense. It's an expense. Now, what is this expense? Is this expense prepaid or is it in arrears? Now, let me give you the example. Let's say you are now the insurance company. I am the person that's taking out insurance from you. So when there's an expense, it means normally when there's an expense, it means I owe you as the company, right? But now if I've paid you beforehand, I don't owe you anything, you now owe me. So meaning that the prepaid expense, now remember, asset is good and a liability is bad. So if I paid you beforehand, you now owe me, I don't owe you. So that is good for me. So a prepaid expense is an asset. Prepaid expense is an asset, and it means I must minus it because it does not belong here, it belongs in the next financial statement. Okay, let me give you another example. Let's draw here. A rental income. Okay, so now we're going to talk about income. So rental income is income, right? We know that. Now, it was paid for 250. You paid 250. I am the landlord. You are the person that's renting from me, right? So, you are the landlord. I'm the person renting from you. So, I must pay you 250 every month. But I pay you 250, right? So, the rental income is 250. But it is still outstanding at the end of the year. Meaning, I paid you for November, right? And you gave me the accommodation. So nobody owes no one in November. In December, you gave me the accommodation, but I haven't paid you yet. So what's going to happen in January? In January, I must pay you for January, and I must pay you for December, because I did not pay you December's outstanding, right? So when an income is in arrears, so this is an income, and now the income is in arrears. It's called accrued, right? So it means that seeing that you are now or I am the landlord, you are renting from me. It means that you must pay me double in January because you did not pay me in December. That means it is not good for me, right? It is not good because for you, because now in January you cannot pay me 250, you need to pay me more. You need to pay me 500 rand. So it is an income that is outstanding, is called accrued income, right? For you it's bad, but for me it's good because I'm going to receive double the money. So accrued expense or accrued income is good for me. You're going to add it because I'm going to receive more money. So what is it that we need to know? That an expense that is prepaid is an asset. You just do the opposite. So if this prepaid here, accrued will be on this side and prepaid will be on this side. Okay, when we do the question, I will explain this again. Okay, now there's something I also need you to remember. Stationery is normally an expense, right? But when you see the word stationery on hand, it is no longer an expense. Because of this word on hand, it becomes an asset. These are just things that you need to remember when we're doing the question. Then we get inventory. I did tell you this in class. Inventory, you get two types. You get the perpetual, and you get the periodic. Now the difference between the two, the perpetual, they will give you cost of sales is given. They'll give you the cost of sales amount. But with periodic, you need to calculate the cost of sales. How do you do that? Opening balance inventory plus purchases plus purchase return, carriage on purchases, meaning it's transport on purchases, minus purchase returns, minus closing balance inventory. Right. And then we have one thing that I told you that you need to remember. When I spoke about it, I said I was talking about the retained earnings. Sorry. The retained earnings and profit. I told you to remember this because we're going to see it again. The difference between retained earnings and profit. Retained earnings is prior years, previous years, and profit is current year. I told you there's one more thing that operates the same, and this is called depreciation. Now, cumulative depreciation is always previous years, and depreciation is your current year. Okay, now depreciation is actually an expense, but it's not money. Depreciation is when you buy a car. Let's say you bought the car last year in 2022. If you want to sell the car this year, the car has lost value. Why? Because you've used it. Now that decrease in value, right, is called depreciation. Now that's what we need to calculate every year. Okay, so now I just want to erase this page. Let's do an example, right? So you buy a vehicle, you bought a vehicle, so you bought a vehicle for 100,000. Okay, and the vehicle is depreciated at 10%. So the year end is 31 December 2020. And then they tell you the accumulative depreciation is 20,000. Okay. So what information did they give you? First, they told you bought a car of 100,000. That's the cost price. Then they tell you that the vehicle is depreciated at 10%, meaning the value drops 10% every year. They give us the year end, which is 2020. And they tell us there's a cumulative depreciation. So as soon as they say there's a cumulative depreciation, you know you didn't buy the car in this year because there's depreciation that has taken place previous years. Now with depreciation, there's two ways. There's actually four ways of calculating it, but we only use two in this course. The one way is called the cost price method or straight line. That means the car will be depreciated the same way every single year. The second one is called the carrying amount or reducing balance method. Right. Now this one, how do you calculate depreciation? You take the cost price, which is the amount you paid, times the percentage. And you do it every year, meaning the cost price will not change. If you paid 100,000 for last year, you paid 100,000. This year, you still paid 100,000 last year. The cost price never changes. But with the reducing balance, the formula is cost price minus accumulative depreciation gives you the carrying amount. And then the carrying amount you will multiply by 10%. Now what this means is, I bought the vehicle for 100,000. I minus the cumulative depreciation. I want to know what's my carrying amount. Now carrying amount is the value of the vehicle today. Okay, so let's go and do this quickly. Okay, so now this is what they told us. We bought the vehicle for 100,000, so this is the cost price. They're telling us the vehicle is depreciated at 10%, and they're telling us we've got a cumulative depreciation. Okay, so now let's calculate what is our depreciation using the straight line method, and what will our depreciation be if we're using the carrying amount or the reducing balance method. Okay. So, how do we calculate depreciation? Using the straight line, we say cost price times the percentage. So, we're going to say cost price multiply by the percentage. What's our cost price? 100,000 multiply by 10%. So, our depreciation will equal to 10,000. The next year, you do exactly the same calculation. Okay. Now, with our carrying amount, how do we calculate depreciation? With carrying amount, you always need to use the formula. So you're going to say cost price minus accumulative depreciation equals to my carrying amount. Then I'm going to multiply it by the percentage. Okay. So what's my cost price? 100,000. What's my cumulative depreciation? 20,000. So what's my value today? 80,000 times 10%. So meaning my depreciation is 8,000. Now, what's the difference between the two? The one just calculates it the same every single year. The other one looks at what's the value today and calculates it on the value. Okay. Now, what else is it that we're going to need to know is our financial statements, right? Financial statements, these three. Now, remember I said I'm going to incorporate the two into one. Okay, so what is it that we need to know about our financial statements? The first statement is our statement of comprehensive income. Statement of comprehensive income. Firstly, what is the framework? Framework is sales less cost of sales equals to gross profit plus other income equals to total income less expenses equals to EBIT less interest equals to earnings before tax less tax equals to earnings after tax. Now this earnings after tax is actually either your profit or your loss. Now I would suggest to do this first, right? Why? Because you're going to need this amount in the other statements. Now I'm going to incorporate these two statements together. Let's incorporate. So I'm going to make this one, right? I'm going to make this one statement. Now, what is it that you need to go and look for in the statement of comprehensive income? First thing you need to go look for your cost of sales. Is it given or must you calculate it? And you need to know how to calculate it. Opening balance plus purchases plus carriage on purchases minus returns on purchases minus closing balance. Okay. So we are done with the first statement. The second statement, I'm just going to write the formula for you, is opening balance. This is called the statement of changes in equity. This one is only interested in the owner's money. So it's opening balance, capital, plus additional capital contribution, plus or minus profit. So you will add if it's profit, or you will minus if it is loss. Plus retained earnings if you have, and then you will minus drawings will equal to your closing balance capital. Now this is your equity amount. Okay, so what actually happened here? This amount that you got here, you're going to use here. You're going to carry it over just as is. And then we have our last statement. Let me just try and do this one. I'm just going to lift this one up a bit. Statement 3 of financial position. Right? So this is the statement of financial position. Just trying to make space here. This is the third one. So this statement's framework is always assets, excuse me, non-current assets plus current assets is equal to total assets. Then we have equity and liability, right? Then we have equity. Now, what I said, incorporate into two statements. So you won't do the third statement, but you will do this framework here. You will do it here. And then this closing balance amount will then be your equity amount. So here you will write opening balance capital plus additional capital contributions plus profit minus drawings, and the answer you get here will then be this answer. And then you will say non-current liabilities plus current liabilities will give you total equity and liabilities. But for you to know if this statement is balancing, you will then have to make sure that this amount here, let's call this A, is equal to this amount here, which we will call B. Then it means that your statement is balancing. Now, in the previous study units, we spoke about solvency. So meaning if your assets is equal to your liabilities and your equity, assets meaning everything you own is equal to the people that you owe, your business is still solvent. Okay, so let's just recap, right? First things first. You're going to do your statement of comprehensive income. Then you are going to check cost of sales. Is it given or must I calculate it? Then you are going to do the rest of it, and then you're going to get an answer which is called your profit and your loss. This profit and loss amount you are going to use in your equity statement, right? So let's say if this is 20,000, this profit here will be equal to 20,000. Then you will do this part, but you can do this part in the statement, meaning that you don't have to do this statement. You basically just take this part and do it in the statement of financial position. And then with the financial position, so now your list, your cheat sheet that I gave you, you will now have to go and look on the question and see everything that's non-current assets, like for example, your land and building is non-current, your motor vehicle, your fixed investment, your furniture, all this will fall under your non-current assets. And then your current assets will be your bank, your inventory, and your debtors. And this is basically what you need to do. So if we give you a question, you then basically going to do two statements. You're going to do two statements. One statement of comprehensive income that only includes income and expense. And you have to do a statement of financial position which includes assets, liabilities, and equity. And you need to remember, under the equity portion, you need to do the equity calculation, that is the opening balance capital plus your additional capital contribution plus or minus profit or loss. Now guys, if they don't say anything about retained earnings in your question, don't even put it in here. Minus drawings gives you your closing balance capital. This is actually your equity answer. So if this answer is 15,000, your equity will be 15,000. Okay, guys, so this is what you need to know before we do the two statements. Thank you so much. The next video will show you the statement. We'll start with the statement of comprehensive income, followed by the statement of financial position. Now, you need to remember, it's wise. You don't have to, but it's wise to first do this statement. Why? Because this statement is going to calculate the profit or the loss that you are going to use in this statement. Okay, thank you so much. Enjoy your day. Bye.